Hello, Jeff. Welcome to the Founders Podcast.
Hey, thanks for having me, Ash. It's a pleasure to be here.
Great stuff. Jeff, before we move forward, do you have a favorite motivational quote, something that inspires you, you would like to share with our audience?
Sure, if I can be so bold as to quote myself, I guess that's what we attorneys do, right? I adopted a slogan 12 or 15 years ago in my practice that is very simple, and it's one that I kind of live by in my life. I try to accomplish it with my clients, with my family, and that quote just is, "Innovate with confidence." It's something that really struck me, very firmly and strongly years and years ago when I first thought about it, because I thought, how do I, what is it I want to accomplish with my clients? Sure, I want to provide legal advice as an attorney, and I want to be a guide, provide guidance and business advice where I can. But really, it's to bring confidence to the people that are around us, I think. So that's what I'm going to go with today.
No, that's definitely a good one because we see quite a lot of people nowadays who have all these capabilities of building great products, but they don't have confidence to sort of put themselves in front. Lately, we were having a discussion in bar with my friends around Meta poaching quite a lot of AI talent from around the world.
Hmm.
Actually, Mark was offering deals of 300, 400 million dollars to each engineers working in OpenAI and scale up AI things, not to scale up OpenAI and then Anthropic, I think so. And he was offering it as a 3 years deal, like 100 million salary for first year, and then you're vested the moment you join them. You have all the shares and everything. I was like, what's
Mm.
happening in the world right now?
It's a crazy time for sure. Yes.
It's a crazy time. It's a crazy
And the
time.
and the people who are seeing success often are the ones who move forward with confidence more than the ones who kind of hold back and question themselves along the way.
Indeed.
Not to be overly bold, of course, and
Yeah.
confidence, I think, is built through action, but also through being smart about the moves that you're making, and not blind courage, right?
Yeah, yeah, definitely, definitely. Couldn't agree more. So Jeff, question number one. I know you've been an attorney for a very long time. You have helped hundreds and hundreds of businesses with their not just legal, but also how they want to proceed, to protect themselves, going forward in the business. I would like to start with a very basic question, which founders always, talk about. Why do so many startup founders end up with crumbs at exits while the VCs walk away with the cakes, right? Can you walk us through how early mistakes in the deal terms set founders up for a disappointment even after a successful exit?
Yeah, that's a very loaded question. So we could spend as much time on that as you like. So I think there's a very visible, tangible trend in the market right now. We're seeing a lot of people who have raised money in the past and had some level of success in terms of an exit come back
Mm.
and say, "Wait a second, my company was successful. The investors did well, but I didn't earn what I thought I would earn. By the time that we achieved this exit transaction, um, my ownership has been diluted so far that I really didn't. I'm not sure I was even compensated for the time I spent uh, in the business." And so we're seeing a lot of people rethinking this divide between raising money and bootstrapping. And there's not necessarily a
Mm.
right answer. They're different mechanisms. I think well, I think that generally speaking, people are going into I think there's two reasons to answer your question. I think there are two reasons that people don't end up with what they think they should in the end. And one is the markets change. There are some external factors that we can't control, and when investment dollars are very accessible, and then they're not, like we've seen in the
Mm.
past few years, people get kind of caught in the bottom half of the cycle, and maybe they could have planned around it, but usually those VC seekers are not necessarily thinking about the downturns. They're thinking very optimistically. So the
Mm.
external factors catch people. But then the other thing is, founders don't always set up the deal right. Founders are often less experienced and less informed about what they could do in a deal, setting up the term sheet and the investment docs, than the investors. The investors do this day in and day out, and they're very experienced. Some of them are very, what's a good word? Some of them are very nice and founder friendly, and others are not. Others are more manipulative and self-serving to the detriment of the founders. And so setting up the deal from day one is kind of what sets the ball in motion. And sometimes these founders, after their first raise or their second raise, even if the business does well, they might not know it yet, but they're probably on a path to exiting without a lot of financial benefit.
Mm, mm. Would you be able to talk through around, many first time founders think giving up equity is just the cost of growth, right? What are the silent killers hidden in these early stage deals? Like what are few clauses or mechanisms founders should fight tooth and nails to avoid, even if it means walking away from the money?
Yeah, let's start high level, because I think there's some maybe high level things, and then there certainly are specific legal provisions that are less friendly to founders than others, and so we can jump into those. But at a really high level, I think there are a few things that really kill deals, and one goes back to what I was saying earlier. If you get an investor in your business who's not founder friendly, you're going to struggle. So there's a lot of due diligence that you need to do around investors. Talk to your circles, talk to your community, talk to other people who are portfolio companies with that investor, and figure out what it's like to work with them. And treat this like you're getting into a marriage. I guess I don't know who does due diligence on their spouse this way, but you date for a long time often before you marry. And in the VC world, you're like, oh, I got a yes at first meeting, got a yes. You wouldn't necessarily do that outside of the VC world. So vet your VC, vet your investors, even angel investors I've seen sometimes that are or strategic partners that appear to be very amicable or very eager to invest in you turn out to not be founder friendly. So that's number one is vet your investors. Number two, I would say keep it simple. The more complex you make the deal, the harder it's going to be to manage it. And so keeping it simple and writing it down, if you can't write it down, then it's probably not simple enough. So keep it simple to the point that you can write it down, and then write it down. As an attorney, this is my number one thing: write it down. Too many founders go into deals and they don't have things written down. So that's another one. And then just again at a high level, the third one that I was thinking of sharing was that it just slipped my mind here. I'll come back to it. It was
No
important,
worries.
but
Yeah.
I'll come back to it.
Great. So vet your investors, vet your early stage investors, and then make sure the deal is simple enough so that you can write it down yourself, and
Yep.
do make sure that you write it down. If we drill down a little bit deeper into that, into the clauses we have in the deals, just to understand more, like what are the terms which founders should be aware of when they're looking into a term sheet?
Yeah, and let me come back to what I was just thinking of before too, if I can. But then we'll get into some of the provisions.
Sure.
Wow, I'm like in a loop here. It just escaped my mind again. I thought of it. I gotta listen better and not think while you're talking. But let's get into the provisions. It'll come back to me.
Sure.
I've got too many things going on. So there are some provisions that I would start out with. I would say, hey, at the beginning of a deal, right? You're going to write this down. Oftentimes we call it a term sheet, meaning you're just simply it doesn't need to be complex, right? We're just writing down the major points of the deal that we want to negotiate before we do all the documentation. There's no reason to do documentation if we can't come together on the major deal points. So there's some initial stages that I would look at in that, and then there's some deeper stages. So at the beginning of putting a term sheet together, right, I think there's a couple things you want to look at. One, and this is a little controversial, but confidentiality. You want to look at who it is you're dealing with, and in a term sheet environment, it could be investors, but your investor might be a strategic partner, and strategic partners often are in the same industry as you, and they might be, active competitors potentially, in some senses. So confidentiality is often dismissed. Oh, investors never sign confidentiality agreements. Well, that's not true. You can ask. They might not sign it, but think about the type of deal and the type of investor or partner that you're entering into with, because there are times when confidentiality is super important, especially if you're going to reveal what I would call highly sensitive information, right? So
What does what does confidentiality mean? Does it mean that as a founder I get to know who's putting money on the table, or as a founder I have a right to hide my identity or the IP to other people? Which way the
Oh,
confidentiality works?
that's a great question. So confidentiality, typically what you want to do when you're an investor is you say, I would like to share my information with you, but this is information that I'm using to make money, right? It's very important to me, or it's maybe IP that I'm developing but I haven't yet released to the world, or it's my financials or my customer list, things where it's important information to you, and you wouldn't just go out on the on the internet and say, hey, here's how I make all my money, for somebody else to see all that, right?
Yeah.
And so there's information that you want to keep confidential to the extent that you can. And so we're really talking about confidential information about your business. And sometimes the investors or the party seeking the investment also want the fact that they're negotiating about investments to also be confidential. So there's different layers of confidentiality, what you want to be confidential, and then how confidential you want that to be. So, for example, if you're doing a strategic partnership deal and entering into, or you're doing, selling your business, say to not for an investment, but selling your business to a buying party who's a competitor of yours, you might say, hey, I'll give you a little bit of information. So this is some of our confidential information, but I'm not going to give you our most sensitive information right now. We're gonna create layers of confidentiality so that you don't have full access to my most confidential information. And that might be, signing formal confidentiality agreements that have very strict clauses in them, like liquidated damages. If you breach this confidentiality, if you use this confidential information for your own benefit, or if you disclose it to somebody else out there without my permission, then you owe me $100,000. So that's not something you'd normally put into just a basic confidentiality agreement, because nobody would sign it. But when you're doing some of these deals with certain parties, you have to be more careful. Another thing that you might do is, I was just talking to a buddy yesterday at lunch, and they're doing some of these deals, and we were talking about highly confidential information. Oftentimes, you might want to agree to disclose that to an intermediary third party, somebody who's a neutral, maybe another attorney, but somebody who you can trust that won't disclose all of that to the other
side
party directly.
Yeah.
And so you might have a financial analyst come in and say, well, I've got access to the data, I've looked at the data, here are my general findings, but I can't share the data with you directly, right? So there's just different ways to set up confidentiality to protect the information that you've got in your business. So
Got it.
that's number one.
Go on then.
Yeah. Number two, and again, this is at the kind of the very initial stages. Number two would be whether or not something is binding. So a lot of times parties come together, and most frequently you'll see that they say, hey, we want to do a deal together. Let's get together. Our CEOs have talked. They like each other. We want to explore the possibility of investing in you, or partnering up, or buying, or whatever it is. And so you say, okay, let's document this. But this is all non-binding, meaning you can't legally enforce any of this stuff. So we're going to talk about a purchase price, but that doesn't mean we're going to sell it to you at that price. We're going to talk about some of the terms you and I will talk about later. We'll talk about these things. But that doesn't mean we're bound to that. These might change. So you want to make these things non-binding typically, to the extent that you can. And most parties don't have a problem with that. And then the third thing I'd say at a kind of the very initial discussion is exclusivity. Because some of these partners, when you come in, they'll say, hey, listen, I want what's called a no shop clause, or I want exclusivity in this deal. Like I want, if I'm going to start talking to you, I want you to not keep shopping around for other investors or other partners for the next 30, 60, 90 days. Like stop the activity. That's a big deal. I've had clients do that when they're actively seeking a deal, and that, if that deal doesn't go through, you might be on hold for 90 days. And so you got to be careful when you enter into those no shop clauses or exclusivity clauses. And so those are like the first three things that are going to come up for most deals.
Most days. We saw something similar in a show called Silicon Valley. I don't know if you have seen it.
I watched it. I actually love that show. I've got an engineering background, and that speaks to me. That's
amazing, isn't it?
Movie.
Yeah, amazing. I love that show so much, and then every time when I am looking for some motivation, I go to that show and then try to like laugh and then learn. You know what I mean? Like inside, it feels so good.
There are so many good jokes, and like the way they talk, the engineering talk, and the things that kind of border on legal. Like they say a lot of very very true statements in a very humorous way. So I haven't seen it for a long time. I might have to revisit that show.
Definitely, I'll do that too. So I do want to ask you a real world use case scenario where things went topsy turvy. But before we go into that question, what's your take on dirty term sheets? And how do they still make their way into the founders' inboxes in 2025? Is the problem lack of legal oversight?
Well, let's
desperation
clarify I want to know your definition of dirty term sheets, just so I make sure I'm talking about the same thing.
Okay. So from founders...
Oh, go ahead.
Go on.
So you're just saying that term sheets that are unfavorable to founders. Is that right?
Exactly. Yeah. That's
so unfavorable terms. So, okay. And just to touch at a high level, some of the types of things, and maybe you've seen some that you want to mention, but some of the things I've seen in term sheets, you get into, well, at a really high level, you get into issues of control, right? You have shareholders who control certain things. You have board members who control certain things. You have the executive team who control certain things, and sometimes shareholders come in and they demand certain types of control. One, for example, that I've seen in a deal that I helped a client with, and I tried my best to talk them out of it. They were anxious to close this deal. And this might be answering your broader question, why does it still happen? They were anxious to close the deal, and they put they allowed some terms in there like a veto power, right? The shareholders, this shareholder came in at kind of a preferred level, meaning they had certain rights that no other shareholders had, and they had the ability to veto certain things. And I don't recall exactly what those were, but it could be hiring other key executives, or it could be changing your compensation, or making purchases over a certain dollar amount, either individual purchases or aggregate purchases throughout the year. And it really, that type of veto power can really block the performance of a business. So those are the types of things you're thinking of, right? Who has control over those issues?
Well, did you had a experience in the past? Can you share a case where a startup exited millions, but the founders made almost nothing? What went wrong, and what would you have done differently for them from a legal and strategic standpoint?
Let me tell you about another deal that. So this was a deal where pretty much everything went wrong, and I wouldn't say that they exited, because the outcome is still pending, but it's gone backwards for them. A client of mine entered into a deal with a partner. The partner promised to do lots of things to help, to be a partner in this relationship, and of course they got equity in exchange for the investment of money and services that they agreed to provide.
Let's say $100,000 for 10%, just to give our listeners.
Yep, $100,000 for 10%. And so at that level, you would expect that I'm just thinking about something somebody said. I don't want to jump to the end too fast, but I was at an event with somebody later who was associated with the other side of this deal after it was already crumbling, and he said, "Yeah, our legal team, they kind of prided themselves in setting up gotchas in the deal." And so that might tell you where the end result of this deal went. But in this deal, you have two people who are really eager to work together, two companies, large companies, in fact, and they enter into a deal, like you said, $100,000 for 10%. Well, what happens is they come in and they say, well, I want preferential treatment as a shareholder. I want some of these veto rights. So you can't change the board. I want to be on the board, but they don't participate. They're supposed to, but they don't participate. I want to have preferential treatment if there is an exit, meaning so there's some terms like liquidation preferences, meaning the investors who come in get the first money out of the deal. If they put $100,000 in, and they get 10% of the company, they want their $100,000 out when there's a deal and when there's an exit before anybody else gets any money. And that if there's money, then great. And if the value of the company drops to $700,000, they own 10%, but they still get their $100,000 out before anybody else gets money out of it if the company liquidates. And the other thing that you see is sometimes they double or triple that, which is very difficult. They say, hey, I'm going to put $100,000 in. I want a 2x liquidation preference. So I actually get $200,000 out before anybody else gets their money, right? And so you can see how a liquidation preference puts them at the top of the line, but pushes everybody else, including the founders, who typically have what's called common stock. The common stock is what's left over after all the preferred investors get their money out. And so the common investors get left with nothing in that case. The other thing that they'll do is, just to complicate this a little bit more, is they'll come and say, well, in addition to my liquidation preference, I want participating shares, which means so I've got these preferred shares. I get my $100,000 or $200,000 out first, but then after I get my money back out, then I also essentially become a common shareholder, and I still get 10% of the remaining money that's left over. So you're really double dipping, or triple dipping, and it's the bottom line is, when you get into a deal like this and you have these types of terms, it's usually because, one, you didn't know what you were doing. You didn't have competent legal counsel helping you, or sometimes even when you have competent legal counsel, you get your business into a bind and you get desperate. And you in fact, I was talking with another attorney yesterday about a client that I'm working with, and historically this client has just gotten themselves into a situation where their runway is too short. They need some more cash. They can't find it because if you're not raising before you need it, then you're going to find unfavorable terms if you raise it when you need it. And so they went back.
You mentioned something about stocks, like you mentioned there are common stocks and preferential stock. What are the different kind of stocks in usual founder investor term sheets, or is it like you can make number of kind of stock based on your requirement, or there's some categories which you can choose from? How does that work?
Yeah. Oh, that's a great question. So normally there's just, in a lot of businesses, you'll just see two types of stock, right? You'll see common stock, which is what everybody gets. All the founders get common stock. Maybe early stage angel investors get common stock. But when you have serious investors come in, the investors will request preferred stock. Preferred stock just means it's it's not just common stock. It's a whole set of rights. Like, you've agreed to give me more access to your company than what a common stockholder has rights to. And that means I get, I might get a board seat. I might get the liquidated preference. I might get participating shares that come back and, double dip. I might get informational rights. I might get other voting rights. So you're essentially setting up a contract with preferred shares that says I get all these other rights that common stockholders don't normally get. And so there's those two types of stock come into play. And what you'll hear about, Series A, Series B, raises. And what happens oftentimes is you'll get the common stock comes in. All the founders have that.
Mm.
That's the basic type. And then you'll get an investor comes in, they get preferred shares. And so you might call that preferred, one, or preferred A, or whatever. And then another investment round happens, and you get preferred B, and you get preferred C. And so you get all these people stacking on top of each other. And every preferred share round that you do after the first one basically forces everybody else to get back in line behind the most
New
recent
investor.
investors. Yeah, so common and preferred, but you see these series of preferred happening quite often.
Mm. That's pretty interesting, because this tells me that the saying of, VC world is the world of foxes. They're always looking for better deals. They're not investing into your growth. They're investing into themselves because they want 10x returns.
For sure. I mean, that's their business, and that's
That's their
that's the biggest complexity with all of this, if you ask me, right? And
Yeah.
I'm not against VC money, but if you have, as soon as you raise outside money, unless it's like a little bit of friends and family who don't really want to be in your business, right? Anytime you raise serious money, you're now, in my opinion, running two different businesses. Let's say I had a business and I made an e-commerce product and I was manufacturing in China and I was, advertising on social media and selling it in the U.S. and, whatever other markets, and that's my business, right? As soon as I say, hey, I want some money, I want to grow this thing, and I take a $500,000 investment or a $3 million investment from investors because I've got a plan and I've got a business and it looks good and the investors want a piece of it. All of a sudden, I'm now running the business that I had, the e-commerce business. But I'm also running a separate business, which is I'm an employee, essentially, of this investment firm who has different motives and different objectives than I do. Now, those objectives align really, really well as long as the business is making money. But as soon as the business isn't, on the same growth trajectory that the investors
as they were
want,
expecting. Yeah.
the investors have priority. They've got these preferential rights, and they get to,
Indeed.
as board members, tell you, nope, you got to grow faster, and you got to hire more, and you got to lay off your people, and you got to cut costs, and so we see these big swings, and not to say that that's right or wrong. I think a lot of people have a lot of strong feelings about it, and they're probably all justified. But from a business model standpoint, when you take on investment money, you're essentially layering an investment business model on top of your operating business model, and now you as the executives have to figure out how to run two different businesses and satisfy both businesses at the same time, which I think is, complex.
Indeed. And I want to learn a lot from you. So I've got some terms which I've gathered from different questions asked by different people on different social media platforms to me, right? And before going through these terms, I want to ask you a question and then relate to these terms. So in what ways do we see backed standard legal docs quietly strip founders of future options? For example, anti-dilution clauses, ratchets, or waterfall structures. Most founders barely understand that.
Yeah. So there are some standard documents that people use. A lot of people, when you get into serious rounds, will use what are called the NVCA documents. Very standard. I wouldn't say that the document template, and they're templates. Anybody can get online. You can look them up. You can download them yourself if if you're having trouble sleeping, I guess. But the documents themselves are not necessarily aggressive or dirty, but when you get investors who want to take advantage, they'll put those things in there. So your question about anti-dilution, anti-dilution just basically means, in some form or fashion, the investor says, well, I'm going to invest the prior example we had, I'm going to invest $100,000 for 10% of your company, and I don't want anyone else to ever come back in and be able to take, lower my percentage. Now, that might take different forms. Some people are very aggressive and say, well, my $100,000 investment is 10% no matter what. Even if somebody comes and puts $1 million in, I'm still staying at 10%. That's a super aggressive form of it. I've seen some angel investors who, try to make that request. But a less aggressive form of it would be, hey, I have the right, maybe some preemptive rights to to invest additional money if other investors come in, and if I invest enough money, I can keep the same amount of equity that I had in the past. That's probably not technically anti-dilution, but it's the cousin to anti-dilution, preemptive rights.
But what's wrong with that then? Let's say, for example, you invested $100,000 into my startup and you're asking for 10% equity. Let's say on the second round, I got $1 million for another 10%. But doesn't that mean that your 100,000 now became $1 million because I've got $1 million for the 10%? So you should be feeling good about it. The founder should be feeling good about it. No? Or am I getting it wrong?
So in that scenario, just to flesh that out a little bit, in that scenario, you're saying that the first investor put 100,000 in, later a second investor put $1 million in. They both got 10%, and after the second investor came in, you're saying that the first investor still owns 10% of the company, right?
Yeah.
Because he put $100,000 in.
Yeah.
That's not technically how it works unless that investor has some very special, anti-dilution rights,
Okay.
which I would argue against. So what you would do, every deal that comes in, you have to look at pre-money and post-money. So not to get too complicated, but in the first deal, what we essentially said without saying it was, my company, before the first investor came in, is worth $900,000. After the first investor comes in and puts $100,000 in, it's now worth $1 million because it was worth 900 plus 100 in cash. That's $1 million. So that's why he gets 10%. So to look at the second investor, when the second investor comes in and you say, we'll give you 10% for $1 million investment, what you're really saying is that the pre-money value of that company was $9 million. And how, there's a lot of ways to get there, but it's $9 million. The second investor puts $1 million in. He now owns 10% because 1 million is 10% of 10 million. 10 million is the total of 9 plus 1.
Yep.
And so that's the post money, the pre-money and post money of that deal. Well, what happens is that 9 million was spread out between the prior founders and the first investor, right? At 90% and 10%. And everybody in that next round, unless there are special rights, everybody gets diluted by 10%. So the first owner who had 10% of the company drops to 9. Founders who had 90% of the company will drop to 81%. And so totaling 81 plus 9 is 90%, which is why there's 10% left over. So everybody should get diluted unless you've got special provisions. And that's where these what you call dirty
Anti-dilution
term sheets come into
clauses.
play.
Yeah. And what about ratchets then?
Ratchets are just some of the language around how you evaluate anti-dilution, right? So there's different. You can do weighted averages. You can do ratchets, and so you put clauses in there to say how you do that. What I would say though is for anybody who's doing this, if you're getting into ratchets and the details of anti-dilution, you probably need to be speaking with an attorney. Your deal is getting more complex than what you should be dealing with, and so what your listeners should strive for is not to ever have anti-dilution clauses in their
term sheets.
In their term sheet, because that's where you could see that so going back to the example we had before, we said after the second investment, you have the new investor that owns 10%, you have the original investor that owns 9%, and then you have the founders that own 81%. Well, if that first investor had anti-dilution, this is a small change, but over time it accumulates. You would have 10% and 10% and 80%. So the founders dropped from 81 to 80.
80.
Guess what? That doesn't feel like a bad deal, does it? But when you come in and you say, okay, now we got the valuation of the company is 20 million, but we need 10 million to really, because we've nailed it, we've scaled it, we've got our product market fit, we're going to the moon with this, right? We're ready to really scale fast, and we're going to be a unicorn or whatever. Well, when you take that next $10 million investment, well, and if the first investor keeps his 10%, he normally would have been diluted, by another 2/3. So he should have been down to 9 and then down to 6. Well, he didn't drop at all because he had anti-dilution, right? And if you did that with the second investor and he stayed at 10, you've now got 20% of your company that's captured with anti-dilution. And guess who takes all the dilution?
Founders.
The founders. The
Yeah.
founders go from what was 81 to, I probably should be able to do this in my head, I think it's 54%, right? So instead of being at 54%, they're now going to be something much lower. That might be 40% because they took
Yeah.
all the dilution themselves. And you can see how round after round after round, which nobody plans on this,
Yeah.
but you get into trouble, your company goes through a downturn, the economy, external factors happen, and you're like, we really need this money. We just have to take these terms. And guess what? A sly investor sees that, and they'll put these things in there. They'll say, well, if you need my money, it's more risk for me, and that's probably true. And so I need extra terms. But that's how you end up with over a series of several rounds, founders who essentially end up with 3% of a company that they started and founded.
Indeed. Indeed.
Honestly, that's better than perhaps than some of the issues that I've seen. I recently heard, and this wasn't necessarily a term sheet issue per se, but it was the result of a merger of two law practices. And one of the law practices has the founder of the law practice, 5 or 10 years in, merged with other partners who came in, and then they've together grown the business. And it turns out that just recently I heard that law practice founder has been kicked out of his own firm because he lost control. I don't know the terms of it. This is just kind of secondhand knowledge, but he's been kicked out, and we hear about that with founders all the time. Some founders end up with nothing. Some founders just get booted. They're like, hey, you don't have enough control as either a shareholder or a board member anymore to stay in your company. We now have the control. We're going to make the decision. The decision is you're not a part of it anymore.
That's very, very sad. And I want to learn more about the control from you. But before we move to that particular part of the question, would you be able to throw some light on the waterfall structures? Which
yeah. So just generally speaking, when you get into waterfalls, you're going to be using a program like Carta. I don't know if you're familiar with Carta. Carta is an online platform that tons of investors use. It's a great platform for a lot of reasons, and that'll calculate a waterfall based on all the investors. The waterfall, or you're going to get a finance team involved to calculate it. And some of these get extremely complex. In fact, a call I was on this week with another attorney about a waterfall structure was, he's like, listen, Jeff, this is not ideal. We've basically all agreed this is the structure, but there was a lot of confusion that had to be resolved along the way because there have been so many rounds and different types of rounds and different stages and timing. But waterfall structures just generally mean, who gets the money if there's an exit, depending on the amount of money in the exit, who gets that money first and who gets the money next and who gets the money next. It's the kind of the payout sequence for any money that comes out of that deal. So if you had a company and you sold it for $100 million and you paid off, $30 million in debt, there's $70 million left over. And, in an extreme example, if you had raised $40 million and from investors, and those investors had a 2x preference a liquidation preference that we talked about before, well, they have the right to take $80 million, the first $80 million out of that company, right?
Wow.
You only have 70 left. They get the full 70 if they want it, right? And everybody else is left without anything. That's maybe an extreme example, but it's one that happens, especially when companies they're worth 500 million and then they're worth 200 million, and people are investing at 500 million and getting, and then the market turns backwards for them, and they bring on another round to try to save it. They can't save it, and the valuation drops, and
everything goes.
That waterfall sequence is really easy because the full 70 goes to that one investor. But if you have 7 or 8 different investors across 3 or 4 different rounds, or if you have 100 employees who've come in at different times with stock options and different executive compensation, like, you could see how this could get rather complicated quickly. So waterfall is just who gets the money first, and in what sequence do people get that money, if there's enough money at the end of the deal.
Great. So let's get back to to the control part of it. How should founders think about control versus cash in the early stages, especially when term sheets come with board seats, veto rights, and hidden strings? Is there ever a smart trade-off, or does it always backfires?
Uh, no, but you need to keep balance. I would say that I like your word trade-off. I would probably say balance. Like you've got to do your very best to keep this balanced, right? And because in most companies there are kind of three tiers of control, right? You've got and founders don't think of it this way because when you start a company, you are all three of these, right? You're the executive team, you're the shareholders, and you're the board.
Yeah.
Although there's oftentimes not even a formal board, right? But you're making all these decisions. As soon as you get bigger, you grow, then you start dividing this out and you say, well, I have shareholders. They own the company. And then I have a board of directors. And sometimes the shareholders dictate who might be on the board of directors. In fact, they always dictate that because the shareholders vote those people in. But certain investors come in and require that before they come in that they have a seat on the board. So you have the shareholders who ultimately control the company, but they give some of that power to the board of directors. And the board of directors controls the rest of the company, except they allow some of their power to be delegated to the executive team. And so a founder who starts a company ends up they own the whole thing, so they're the shareholders. They make all the decisions at both the board and the executive level, so they're everything. But as soon as you bring an investor in, then you start seeing that control get shared. And when that control gets shared, as a founder, of course, you have a little bit less control. This is why you hear a lot of founders when they start raising money say, well, I think I'm going to need X dollars in the next 3 years, right? Like I need around here, and I need around here, and I need around here. But if I give away too much right now, then by the time I get to my second or third round, I'm not going to have a majority of the company anymore. Some founders are okay with that, but as soon as you drop below majority, you no longer have control of the shareholder vote, right? And when you bring in directors in, you might start out with it's just you and a buddy, or you and an investor and an independent person, but you have to really manage who's going to be on that board. You manage who invests in your company, and then you manage who's going to be on the board if you want to have any control or say in how things play out at the end of the later stages of your business.
So what about this super voting shares then, where a founder can have 10x voting right per share? Is that a good long-term strategy or a VC red flag? When should a founder push for this, basically?
You mean the founder wants to keep the ability to essentially override other decisions on certain topics?
Yeah, super voting. Well, I don't know what they're called. They're called super voting shares or something else.
Yeah, it could be super voting. I would, in the reverse scenario, a lot of times what we see is investors come in and investors demand a veto, right? Meaning that essentially the same thing you're talking about, a super voting power. Like, hey, if you want to enter into if you want to sell the company, we hear about this all the time. Founders get to a point where, hey, they could sell the company, they could walk away with $10 million from a $100 million deal, and the investors say, no, that doesn't hit my hurdle rate. That doesn't I don't get the ROI that I need out of this. I would rather see that company grow bigger or go broke trying than sell it for $100 million. So until we get to 250, I'm not going to let you sell the company. They have the right to control when the company gets sold because they've got that, what you call super voting power, or what I would call a veto.
Super voting shares, yeah.
So
okay,
if you can, as a founder, if you can negotiate control with your investors, I think that's great. I think what a lot of investors would say, and what founders should say on the other side is, hey, are we, are we working on this together? Are we partners in this, or why are we creating an imbalance in the control of the company? Why as a founder should I keep a super voting power, or why as a founder should I let you have veto rights? And maybe there's a reason for it, but I would aim as much as possible for a partnership, because in any relationship, personal or business, when there's an imbalance, it's a lot harder to maintain that relationship.
So let me ask you one question then. What's one clause you have personally fought hard to include in a founder's term sheet, and it saved them later?
I would fight really hard for So I work with early stage companies. A lot of my clients are the founders. They are also the CEO of the company, and they're the first board member, and they're just bringing in friends and family or early stage rounds, pre-seed rounds of money. What I often talk to my founders about is the ability to manage their role in the company. So, as an executive, what these founders don't want, at least at this stage, is they don't want to get kicked out of their own company. They don't want to lose control. And so we want to talk about how do we protect your role in the company? How do we set up compensation, compensation conditions so that somebody can't come in and say, nope, sorry, you can't ever give yourself a raise, or nope, sorry, I'm going to appoint somebody else. So there's, I think that spreads across different things. It gets into, director, the board of directors composition and structure and voting rights and thresholds. But it also could be very explicit where we say, hey, let's put a clause in there that your role as the CEO is protected, either for a certain time, or as long as certain thresholds are met, or until you hit until certain milestones happen. Like let's protect that role, because ultimately, while my clients technically are the business, and I have to look out for the rights in the business, at the time going into this deal, the business and the founder essentially merge into the same thing, right? Protecting the founder's interest is protecting the business interest. After the deal's closed, that might change, because my role is as an attorney with a business client to protect the value and the needs of the business itself, and there might be a time when things split and we say, hey, I like you as a friend, but you're not technically my client, and if we didn't protect this up front, then I'm going to have harder conversations down the road, and I don't want to do that either.
Interesting. Jeff, this discussion is like I can talk to you for more 5 years, 6 years now. It's like it's so eye-opening for me, and not just for me, for all of our listeners, because this is the thing which we don't learn until we make the mistake.
Yeah.
You see where I'm going? This is something we need sort of like a course on,
Yeah.
If
I totally agree with that. I talk to a lot of people, and one of the things I like to kind of mention is, it's my job as an attorney, or if you have advisors in your, that you can rely on in your business, what you really want to achieve, I think, if you're a first-time founder, you want to be able to think like a second-time founder. Or if you're a second-time founder, you want to be able to think like a third-time founder. You want to be ahead of your game, and the only way to do that I know of is to kind of recruit the knowledge and experience of people around you who've been through those deals or who've made those mistakes. Because otherwise, we're, what's the saying about history? History repeated. We'll repeat the same
repeat
mistakes
itself.
if we don't learn from it, right? So, trying to get the advantage of a serial entrepreneur when this is your first go around is, it's doable, but you have to be deliberate about it.
Definitely, Jeff. It's going really well, but I have to push us to our lightning round because we're running out of time.
Okay.
We've got 6 quick-fire questions prepared for you. If you feel that one of them you don't want to answer, just give me a skip, and then we move to the next one. How does that sound?
That sounds great. I'm excited to hear what they are.
Great. Okay. Number 1, what are the top 3 clauses every founder should think about before signing a term sheet in 2025?
Oh, it really is fact dependent. What I would say to that, and sorry to not answer this directly, I would say all the negotiations happen before you sign. So any clause that's important is extremely important before you sign. After you sign, it's too late to negotiate it. I hope that's a satisfactory answer.
I think that's a very wise answer because, again, as you said, a partnership is like a marriage. You have to date the person for a while in order to accept the money and then get into the marriage. So thank you for that. What book would you recommend to our audience and why?
What book? I read a lot of strategy books myself. I don't know that those are really interesting to people. The one that comes to mind is is it called The Chasm? Or I can't remember. Jeffrey Moore, I think, wrote it, and I'm blanking on the name of it. Crossing the Chasm. It's right here, actually.
Okay.
So it's a good all around book for people who are building businesses.
Awesome. What one attribute or characteristic in your mind of a successful founder?
Detailed, like successful.
Mm.
I've worked with a lot of founders who are visionaries but lack the detail, and that's okay as long as they've got somebody on their team who can track the details. But doing what founders do, from my perspective on the legal side, details are extremely important.
Indeed, indeed. What's your favorite personal productivity tool or habit?
For me, this might sound weird, but my personal productivity tool is to get up and work out every day. Like I am so much more productive if I've spent 45 minutes or an hour working out than if I don't do that.
You wouldn't believe me. I have interviewed more than 150 plus guests on my show already. More than 30% of them has actually answered the same way. Workout is their one of the best productivity tools. So, you're spot on that.
Awesome.
What's a new or a crazy business idea you would love to pursue if you had time?
I love the idea of AI making legal more accessible to people. Legal help it's too expensive in a lot of ways. I mean, I'm not there yet. I'm thinking about some ways to do it. I'm not sure if I'm going to make the jump because what I'm doing is working. But I provide a different type of service than a lot of lawyers by doing what I call a fractional legal team. And if people want to know about that, they can look on my website. But we essentially are an in-house legal team for startups and scaling companies on a fractional basis. I think AI is going to play a huge role, and I'm really excited to see where that comes in. I don't think it will displace good attorneys, but I think it's going to level the playing field in a lot of ways, and I hope to be a part of that.
Perfect. And last but not least, what's an interesting or fun fact about you that most people don't know?
Oh, a fun fact that most people don't know. Well, last year I tried to climb Mount Kilimanjaro, and I got high altitude sickness and had to be helicoptered off. I think some people might know that, but not everybody. And I like adventure, but I'm not sure if I'm suited for high altitude.
Well, you have already blown my mind because I wouldn't even thought to go on Kilimanjaro and right, jump on something and climb it. Although I have seen the movie called Himalaya, where the people goes up Himalaya mountain
Yeah,
and
one called Everest, and
Everest, sorry, not Himalaya. And then everybody, well, not everyone,
most
few
everybody
people,
dies.
yeah,
Yeah, people
die. And
die.
then that was a crazy movie.
Do you want to know a funny story about that?
What is it?
I mean, not that everybody died. That's not funny at all. But because that's based on a real experience. I actually did a couple years ago. I did Everest Base Camp, where
Okay.
we hike for 10 days or so up, or maybe it's 8 days up to Everest Base Camp. And in the second to last town, I think it was Dingboche, where you stay. There's an internet cafe, and every afternoon, and this town is just full of people hiking up towards Everest. Every afternoon they play one or two movies. The movies are Everest, where everybody dies, or a lot of people die, or it's I forget the name of the other show, but it's another show about Mount Everest where people die. And I'm like,
Oh my God.
of all the shows to
Like,
show here, I guess it's just a warning.
mm, mm, interesting. Well, Jeff, thank you so much for joining me and sharing your story. If people want to get in touch with you, people want to talk with you or have a question, what's the best way to do it?
Oh, I'm on LinkedIn quite a bit, so reach out on LinkedIn, or we do a free strategy call for potential clients that want to come in and talk for 30 minutes about strategy and where they're at and the messes they've made and how to clean them up. Also, I'll just suggest that I'll put together a little checklist or a sheet from our call today about term sheets. I'll send it over to you, and if people want to reach out to me and grab a copy of that, I'm happy to share that, or you can share that with them too.
Definitely. Yeah, please do send in. I'll attach that into the show notes below. Great, Jeff. Thank you so much for joining us today and sharing your inspiring journey and the impactful work you're doing for the founders. It's been an absolute pleasure having you on Founders Podcast.
Oh, it's been my pleasure, Ash. Thanks so much.